Hello everybody, this is Dhananjay and welcome to our first video presentation on cost of equity that we are going to calculate on SENSEX, the Indian Stock Index. This SENSEX comprises of the top 30 stocks in Indian stock market. In short, it represents 30 largest businesses that are traded publicly in uh, Bombay Stock Exchange as well as the National Stock Exchange. But we in this video we consider Sensex for evaluating and trying to understand what kind of return that you can expect when you invest in Indian stocks or in Indian stock index Sensex. Uh, so what is the expected return? We are going to calculate that, and also we are going to calculate the cost of equity, that is the minimum return on stocks when an investor invest in Indian equities. I would like to state this before starting this video presentation. This video presentation is just for educational purpose, and it doesn't recommend or recommend any stocks for investment. The investor who's listening to this video should make their own decision, and it should not be dependent on this video. So this is just a educational video. So we would like to state our disclaimer in the beginning. So let's go to the first slide. Now, Sensex, what is the current valuation of Sensex? Generally, when you value a stock or when you value an equity based index like Sensex, it is generally measured in terms of three ratios. The first ratio is price earning ratio, and the second one is book value, price to book value ratio, and the third is dividend yield. Let's go one by one. First is PE ratio. PE ratio is nothing but the price, that is the market price for a security or for an index, divided by the earnings of those securities, that is the earnings of the underlying business of the securities. In stock market, by security we mean the equity stock which is traded in the stock exchange. Now Sensex is trading at somewhere around 28,000 plus. We will see that number in precise terms in the subsequent slides. At the current market value, market price, Sensex is trading at somewhere around 19.58 times the earnings. So if, for example, if Sensex stocks or Sensex companies, underlying 30 companies, if they earn 1 rupee, Sensex is trading at somewhere around 19.58 rupees. That is the current market rate of Sensex. So the PE ratio, the last trailing 12 months PE ratio is 19.58 times. And the price, second ratio, the price to book value. Book value is nothing but the accountant's estimate of the underlying business of a security. Here in this Sensex, 30 stocks book values taken as the underlying estimated accountant's value on all these 30 companies, 30 businesses. So the price is the Sensex value divided by the market value of the underlying 30 businesses of Sensex, which works out to be 3.06 times. That is, it is trading 3 times the book value of the underlying 30 stocks. And the third ratio is dividend yield. Profit of these companies are sometimes distributed to the shareholders or the equity owners or the owners of the businesses as dividend, which may be a part of the profit, or it can be the entire profit, or it can be the part of the profit. So dividend yield out of the earnings paid by these 30 companies to the shareholders is 1.18%. That is, if they earn 100 rupees, they give cash of 1.18 out of the profit to the shareholders. This is the dividend yield. So yearly, this is a per annum dividend yield. If a company earns 100 rupees, they give you 1.18 as the owner of the business. So this is the cash, actual cash, which the shareholder receive from the company. So the dividend yield for Sensex is 1.18. So this information is provided by the BSE Stock Exchange website, or bseindia.com. So you can go to this site and get these values. The current valuation ratios, the ratios that we are discussing in this slide, is as on 7th February 2015. That is yesterday's closing price, based on the yesterday's closing value. So let's go to the second slide. Now let's see how historically Sensex have been valued by these three ratios. Right from 2002 to 2015, the valuation ranges from the lowest level in terms of PE. The lowest level is somewhere around 12.68, which happened after the aftermath of this Lehman Brothers collapse, and the entire world, got into a great turmoil, and due to this subprime crisis in US and the bubble burst in the real estate market in US, that has resulted in a global meltdown in 2008-2009. So here, the valuation ratios are all-time high in the last 1.5 decades or 2 decades, we can say. So that is where Sensex was trading at a very low valuation, that is 12.68 times, and the highest value is somewhere around 21.05, which is in 2010-11. All these ratios are at the beginning or of the subsequent years. So now, what is the value? Going by the history, the price to earnings ratio is 19.58 when compared to historical low of 12.68. So we are near to the all-time high as per the PE ratios, going by the history of last 15 years data. And by price to book value, again, the historical high is in the year 2008, that is just before the crash. In 2008, price to book value for Sensex is 5.19, and now we are at 3.06. So we are not, as per the price to book value ratio, we are not very near to the all-time high, but still somewhere in between high and low. Again, the lowest value is in 2009. See the beauty of the market. In 2008, it was 5 times the book value, and in 2009, after the global crisis, subprime crisis, it is 2.47, somewhere around 2.5. So this is the beauty of the market, the volatility of stock market. But we have to stay with the financial tsunamis that is happening then and there at regular intervals, say around 5 to 6 years once. It's happening, but we have to sustain that. Then only you can earn a very good return in stock market. And going by the third ratio, we are trading. This is inversely related. So if the dividend yield is low, the stock market, price will be high, and if it is high, if the dividend yield is high, the stock market would be trading at a low value. This is inversely related to other two ratios. Okay, this is the historical value, and here we need to find some important ratios, like what is the last 13 years 13 years compounded annual growth rate in the earnings. So earnings yield is nothing but 1 divided by the price earning ratio. This is 1 divided by 1.75 in 2002 gives you a yield of 5.7. So the earnings yield is 5.11 for the current year. However, it was high in 2009, that is after the crash. It's 9.89. Here, this was the time when when as an equity investor, when you invested in this period, you would have gained a wonderful gain. See, from 9,720, it peaked up to 27,485, or it is 28,717. So from 9,600 to 28,717, which is a very good return from 2009 to 2015 or 2014. We are in the beginning of 2015, so it has given a wonderful return in the last 5-6 years. So if you take the compounded annual growth rate of earnings, it was, say, earnings was 192.44 for the consolidated 30 businesses. This is just a ratio. This is not rupees, or this is not a currency. This is just a representation, because we give weightage for all the 30 stocks, different weightage for 30 stocks, and calculate this 192.44. This 192.44 have grown to 1466.7 in 13 years. And if you see the earnings in 2009, in terms of earnings in 2009, it is just 1377, and it has gone down in 2010 to 974.3, which has gone up to 1466. It has just doubled, or less than doubled. But the value, see the value, this is the beauty of stocks. The value have almost tripled, whereas the earnings have just doubled. This is the wisdom of market. Value will not grow. It may grow more than the growth in the actual underlying earnings, or it may go down irrespective of whatever the earnings. That is the beauty of the market. And this is, to understand this, it is like a search for a holy grail. Never in my life, or never in our life, we are going to find out the magic spirit that is acting behind the market on all these ups and downs. That is the beauty of the market. So let us not explore the the magic, or the wisdom, or rationality, whatever people say, and how it works. It is really an unexplained concept. It is a human psychology basically, but here we go by the fundamentals. So if we just go by these fundamentals, you can be a winner in stock market, or winner in a stock investment. So let's go by purely by the fundamentals, because the directions of the market is not in our hand. Going by the growth in the actual earnings in the last say 13 years, it's somewhere around 16.91. Actually, this 16.91 is the compounded annual growth. Okay, so this is the historical analysis of the valuation of SENSEX. But let us go and let's, before going into that, what is the what is the compounded annual growth rate in the last 10 years from 2004 to 2014? It is 17%, 17.3%. Let's take 17%. This 17%, let us assume, if you have say a 10 lakh rupees or 1 million rupees, if you have invested this in SENSEX, you would have got a compounded annual return of 17% tax free, because when you invest in stocks, if it is more than 1 year, there's no capital gain tax in India. So from 2004 to 2015 or 2014, you would have gained 17% tax free, against if you would have invested in bonds, or if you would have invested in fixed deposit, you would have gained after tax return of somewhere around 8% or 8.25%. 17% versus 8.2%, it is just double the the return. So investing in stock is more profitable, provided it's a long-term return. So long-term investment, you cannot expect this in short term, because say if you have invested in 2008, in the beginning of 2008 or 2007, and your stocks would have dropped by almost less than almost 100%, or sorry, 50-60% of your total value would have lost. But you cannot time the market. You have to invest, forget, and invest in good stocks. Keep investing in stocks when the stock price goes down. You should have that kind of conviction and courage to do that. If you do that, you will definitely beat the market, or sometimes you can definitely earn more than what you would have earned in a fixed income. So this is the historical analysis of SENSEX. Let's go to the second slide. Yeah, how are you going to calculate the cost of equity, which is the expected rate of return on SENSEX? Here we are going to adopt a capital asset pricing model modeled by William Sharpe. So it's nothing but CAPM is calculated by risk-free rate of return plus the beta into the implied equity risk premium. To be more conservative here, we add the default spread issued by the rating agencies for countries. For India, the default spread is 2%, and beta for the market, this is by default for any market, the beta is 1. So Here we just take beta as 1. Now we have to calculate risk-free rate of return in India and also the implied equity risk premium for SENSEX. So let's do that. Now, risk-free rate of return in India. We are taking 10 years T-bond yield of Government of India. We can get this in Bloomberg. It's freely available. This is the link. And if you see the last 1 year chart of dividend yield of 10-year bond, T-bond rate of Indian government, it has dropped. In the last 10 months, it has dropped from 9.1% to somewhere around 7.7%, which is 15% drop in the yield. So if you have invested in Indian bond, T-bond, 10-year bond, in April, that is immediately after the election or before the election, you would have lost 15% of your capital. So investing in bonds at the current situation in the last 10 months at least, it's not a profitable one, it's a loss making one. But again, here our objective is to get the risk-free rate of return, which is the current yield of Government of India's 10-year bond, T-bond, treasury bond is 7.7%. The current yield is 7.7%. So that is our risk-free interest rate. Let's go to the next slide. Now we have to calculate the implied equity risk premium for SENSEX. Now, the current market code, what are the components that we are going to use for implied equity risk premium? We are going to take the current market code of SENSEX. We are going to take the earnings yield of SENSEX and the estimated growth rate of earnings of SENSEX stocks and the terminal growth rate of earnings of SENSEX stocks. So these are the 4 components that we need for computing the implied equity risk premium. And with these inputs, we are going to work backward, taking the current market price of SENSEX, and we are going to estimate the expected return on stocks, which we will work for backward in the subsequent slides. I will show you how we are going to calculate this expected rate of return on SENSEX in future. And with the expected return, with this first output, we are going to use this as a discount rate for discounting the cash inflows of SENSEX businesses to calculate the equity risk premium, which we will get out of discount rate minus the risk-free rate plus the default spread for India, which is given by Moody's. We will do that. This is at the current stage. It will be looking, it will be a bit confusing. But when you see this slide, next slide, you will understand. The next slide. Here we go. This is the current market code of SENSEX. So we are going to forecast this growth, the earnings of SENSEX in the next 5 years, and also we're going to calculate the terminal value of SENSEX using the expected rate of return on stocks. Here, this we have calculated by working backward. Let me explain this first. So here, the earnings yield based on the historical earnings yield, we have taken the average of earnings yield, which is 5.45% for SENSEX, and we are applying this rate as a earnings yield, for this current market code into the earnings yield gives you 1565.85. Now we are going to take this at a constant growth rate, at a compounded annual growth rate of estimated growth rate in earnings as 16.91%. This is again we are taking from the historical growth. We assume here that the earnings of SENSEX will grow at the historical growth rate of SENSEX. So 16.91%, we have taken this in the, this one. This is 16.91%. This is the earnings growth in the last 13 years from 192.44 to 1466.7. We have taken this as the estimated growth rate in earnings for SENSEX. So we are applying this growth rate and we are calculating this. Now the discount factor, this is the discount factor 15.23%, but we are using what if conditions through Excel, a goal seek function, and we are arriving at this number. Now the terminal growth rate here we consider as 6.5%, which is the GDP growth of the country of GDP growth of India. Currently it is estimated less than this, but we assume that in future India will grow at least by 6.5% over the next 10 years. And that's possible with the amount of population that we have, the potential that we have in India. I think 6.5% GDP growth is a very nominal expectation. So we assume 6.5%. So with this, we calculated the terminal growth rate and we are discounting it back to the current present value using this as a discount rate, that 15.23 as a discount rate. So when we work backward, we match this and this, the current with the current market price of SENSEX. So we get 15.23% as the expected return on stocks, which is the discount rate for the entire calculation. Expected rate on return on stocks is 15.3%. If we deduct this 7.7% and 2%, not 2%, sorry, risk-free interest rate 15.23 minus the risk-free interest rate of 7.7%, we get 7.53. This is the equity risk premium. So the equity risk premium for Indian stocks would be 7.53%, and any person who invests in Indian stocks would expect excess of 7.7%, which is 7.53%. So he will be expecting to double the double the interest yield on 10-year bond, which is 7.74 plus 7.53. This would be the minimum expectation, and to be more conservative, we add this default spread of Moody's for India as 2%. So the cost of equity that we safely estimate is 7.7% plus 7.53% plus 2% default spread given by Moody, so which works out to be somewhere around 17.23%. This we assume, we safely assume that this is the cost of equity for SENSEX. So what does it mean actually? Before going to this, I made a small mistake which I have to rectify. In the previous slide, we said implied equity risk premium is calculated as discount rate less risk-free rate, and actually this is not the case. You should not add default spread for default spread given by Moody's. This we should add only to calculate the cost of equity for SENSEX. So here we are adding it. It's like 15.23 minus 7.7 is 7.53, which is the equity risk premium. With this, we conclude that the cost of equity for SENSEX, which is calculated as 7.7, which is the risk-free rate, plus beta into 7.53. Beta for SENSEX is 1 because market beta is always 1. It cannot be more than 1, or it cannot be less than 1. So 1 into 7.53 plus the default spread for India given by Moody's is 2%. So 7.7 plus 7.53 plus 2, it comes to somewhere around 17.23. This is the cost of equity for SENSEX. Now we have calculated the cost of equity for SENSEX as per the CAPM model, but what does it really mean? What does it mean? When one invests in Indian equities or in an index fund which is based on SENSEX, an equity investor can expect a minimum return, if he's a minimum return of 17.3% against risk-free return of 7.7%, as well as safe return on fixed deposits in Indian banks, Indian public sector banks, I say somewhere around 9.25%. This is pre-tax. Post-tax it would be somewhere around 8.25% or 8%. And this is what he would expect if he's going to invest in stocks, 17.3%. Why 17.3%? Because he wants more return by investing in stocks, because he's taking extra risk in investing in stocks. Stock is not a safe investment like what fixed income investment. Anywhere in the world, stock is always risky, but one has to be compensated for the risk that one takes. So this is the premium that is going to get, excess of 9.25% or excess of 7.7%. He's going to get somewhere around 9.5 or somewhere around 9.5% excess of return if he's going to invest in stock. But this is the minimum return that he can expect. If his mutual fund investments or any index-based investment, if it has achieved less than 17.3% in the last few years or few months, then something is wrong with his investment, and he should go back and analyze and correct his investments or restructure his investment or portfolio in stocks to get at least 17.3%. It should be more than 17.3%. It should not be less than 17.3%. This is the meaning of the cost of equity for Sensex. And let us just go back few months and see what Sensex have really achieved. The compounded annual growth rate for Sensex, as I said before, in the last 10 years is 17%, which is again, which coincidentally is, correlating with our 17.3%, but that is not intentional. The calculation shows it 17.3%. The compounded annual growth rate for Sensex in the last 10 years is also 17%. Now, how Sensex have performed against the fixed income? Here, by fixed income instruments, we mean the government instrument, the 10-year government T-bond, Government of India's T-bond. So, if you see last, as I previously said in the previous slides, from April to January 15, with a period of 10 months, the yield have gone down from 9.1% to 7.7%. This is percentage, actually bond yield, which is dropped by 15.4%. Whereas Sensex have gone up from 22,384 in the month of April 2014 to 28,000. It's almost touched 30,000 last week, but in the last 1 week it is going down. Current market price of Sensex is 28,717.91, which have yielded a return of 28.3%, which is almost double the fall, absolute fall, which shows stock can really beat the fixed income. But this is a short-term return. This may be the effect of the recent government change and the expected productive budget in the coming months. But still, market is always unpredictable. All these changes, all the expected changes may not happen, but stocks always overreact for any information for that matter. So at present, the emotions are over optimistic, I would say. We have to wait for the budget. We have to wait for the directions of the policies by the new government, which is just 10 months old. It has got again 4 full years to go forward. So we have to wait till the budget and see what the government is going to do regarding the economy, regarding the subsidy, regarding the plans, regarding the interest rate cuts by the Reserve Bank of India. Are they going to control inflation? Are they going to control the foreign exchange reserves? Are they going to control the fuel price, which is very, very volatile in the last few months? It has gone down to 6 years low. But whether this benefit would be there to stay to benefit countries, developing countries like India, we all have to wait and watch. At present, I would say the market is a bit greedy. Because one among the emotions will always act in Indian market, or sorry, not Indian market, in almost in all the stock markets. One is fear or the greed. At present, greed is the emotion that is taking over this market. It may or may not sustain. Only the new budget can justify that. But we are a bit, cautious about the valuation. So we'll have to wait and watch. Now, this is our first presentation. I would like to read out I would like to the readers or the viewers to read this disclaimer statement. And again, we would state that we are not recommending anything. We are just providing you some educations on the valuation of the stocks. So thank you very much, friends. We would come out with some more videos on the cost of various industries. We are planning to come out, present our views on the cost of equities on various industries. So next video would be the 2 and 3 wheeler industry. We will cover all the 2 and 3 wheeler industry, and we will present our view on the cost of equity on that particular industry. Thank you very much.